Most people think the danger is the war. It is not. The danger is what war does to money. That is the part almost nobody sees until after it has already moved through the market and into their life. They watch the missiles, they watch the headlines, they watch the latest tweet, the latest ceasefire rumor, the latest oil spike, the latest green day in the S&P 500. And because they are watching the surface, they miss the mechanism. That is how retail investors get hurt. Not because they are stupid, because they are looking in the wrong place. I have seen this before. Different flags, different decade, different television anchors pretending they understand the future. Same pattern, uncertainty explodes, money moves, retail reacts emotionally, institutions reposition structurally, and the gap between those two behaviors becomes the place where one group loses a fortune and the other quietly builds one. That is the real story. Now, not whether the war gets worse tomorrow morning, not whether oil closes $2 higher or lower by Friday, not whether some politician sounds calmer for one afternoon. The real story is that uncertainty just shattered through the roof, and money is already rotating. If you do not understand where it is rotating from and where it is rotating to, your portfolio is not invested, it is exposed. That is the first rule. Exposure is not the same thing as positioning. A lot of people still do not know the difference. They think owning stocks means they are positioned. Owning random stocks while the regime changes around you is not positioning. It is drifting, and drifting gets expensive when the current gets violent. Right now the current is violent. Tariff uncertainty, trade policy chaos, oil stress tied to Iran, weakening dollar, gold through levels people once called impossible. Inflation sticky enough to trap the Fed, growth soft enough to make every policy choice painful. And yet the broad market keeps acting as if everything can be floated over with optimism and a little liquidity. I do not trust that. Whenever the market starts smiling too easily while the system underneath is getting more unstable, I slow down. I do not accelerate. The amateur sees the green candles and thinks the danger passed. The professional asks a different question. What is the market not pricing properly yet? That is the second rule. You do not make real money by reacting to what is obvious. You make it by understanding what the crowd still refuses to frame correctly. And what the crowd is refusing to frame correctly now is uncertainty itself. People hear the word uncertainty and think emotion. I hear the word uncertainty and think rotation. Because uncertainty does not just scare investors, it rearranges them. Money does not vanish when risk rises. It moves. That is the entire game. The market is not one giant pile of stocks that all breathe together. It is a living map of sectors, industries, sub-industries, and capital flows. Aerospace, defense, energy, pipelines, refiners, software, biotech, consumer staples, airlines, utilities, logistics, miners, real estate, hundreds of different pockets of money. And when uncertainty hits, capital does not sit politely in place. It runs. Not out of the market first, within the market first. That is the third rule. Money usually rotates before it evacuates. Retail investors almost never understand that. They think there are only three choices: sell everything, do nothing, or chase whatever just went vertical. Those are the three classic mistakes, and they show up every time. The first mistake is the cash panic. This one feels intelligent in the moment because fear always feels intelligent right before it gets expensive. You see uncertainty rising, you sell, you tell yourself you are protecting what you work so hard to build. But cash is not neutral when inflation is elevated and the market structure is still rotating underneath you. Cash is a guaranteed real loss if the money in your account is being diluted faster than the bank is paying you to sit still. That is what people do not understand. Cash can feel safe and still be quietly killing you. That is one of the cruelest tricks in finance. The statement stays calm, the purchasing power bleeds. Then, once the panic fades and the market recovers, the person who sold feels paralyzed. He missed the rebound. He locked in the loss. He played defense in the most expensive way possible. That is the first mistake. The second mistake is the freeze. This one is even more common because it wears the costume of patience. People tell themselves they are being disciplined because they are doing nothing. Sometimes doing nothing is discipline, but a lot of the time doing nothing is paralysis. And paralysis is not a strategy. It is an absence of strategy pretending to be one. If your portfolio was built for one environment and that environment just changed, then simply staring at the account and hoping the old structure still works is not prudence. It is denial. That is the fourth rule. Hope is not diversification. The third mistake is the most dangerous because it arrives with excitement, chasing the spike. This is where retail investors do the exact opposite of what smart money does. Gold surges, they buy gold after the first big move. Oil jumps, they pile into the most obvious energy name after the fear trade already happened. Defense stocks pop, they buy the headline names after institutions have already positioned. That is what amateurs do. They buy the first move. Institutions position for the second and third move. That is the difference. The first move is fear. The second move is analysis. The third move is structural repricing. That is where the real money sits. I want to make this very plain. If you buy the thing that just spiked because the news made it feel urgent, you are not doing macro investing. You are providing liquidity to somebody who understood the setup before you did. That is all. So if those are the three retail mistakes, what do institutions do instead? They follow a framework. That is the fifth rule. Serious money always has a framework before it has an opinion. Opinions are cheap. Frameworks survive. The framework I care about here has 4 phases: shock repricing, rotation, then the longer policy and earnings adjustment that follows. The shock phase is when fear dominates. Oil spikes, volatility jumps. The broad index sells off. Gold often moves hard, although even that can behave strangely if forced liquidation hits first. This is where algorithms, headlines, and raw emotion own the tape. Retail panics here because it thinks the first move is the whole move. That is wrong. The first move is almost never the whole move. The second phase is repricing. This is where institutions start asking adult questions. How long could this last? What does this do to oil? What does oil do to inflation? What does inflation do to the Fed? What does Fed paralysis do to rates, the dollar, and the relative attractiveness of different sectors? Now the game becomes interesting because money is no longer just running from fear, it is searching for structure that leads to the third phase, rotation. This is where the bulk of the public usually gets left behind, because by the time the average investor feels emotionally ready to act, institutions have already moved capital into the industries most likely to benefit from the new environment. That is what I want you to understand. Markets do not reward whoever watches the most news. They reward whoever understands where cash flows next. That is why I keep coming back to sector and industry movement. During disruptions tied to war, shipping, energy stress, and a weakening dollar, money tends to move in very recognizable patterns. The pattern is not random, it is logical. Start with energy. When conflict threatens oil or transport routes, energy is the first mover. That part is obvious. But the public gets seduced into the wrong area. It chases the first shiny energy spike. The institutions usually go deeper. Pipelines, storage, refining energy infrastructure, oil services, the less romantic, more durable parts of the chain that continue getting paid after the first panic candle fades. That is where adults look. Then defense again. The public sees tanks and buys the biggest, most obvious contractor it can name. Institutions often look 1 or 2 layers deeper. Components, drone systems, AI-driven battlefield technology, cyber support, the specialized recipients of long-duration defense spending rather than only the first names television anchors mention. Then gold and hard assets, a weakening dollar and rising geopolitical strain increase the appeal of hard money. That is straightforward. But again, smart money looks past the obvious trade. Gold miners, streaming companies, selective ETFs, a whole ecosystem around the metal. Not only the metal itself, then consumer staples. This is where people get bored, which is often a good sign. When uncertainty rises and consumers get more cautious, the companies selling food, beverages, household products, and everyday necessities can become more attractive than the glamorous areas that depend on confidence and expanding multiples. It is not exciting, it is effective. And finance has a nasty habit of making the boring trade look smartest after the exciting trade already blew up. Now let us talk about what tends to suffer. This matters just as much. Utilities are often treated like safety without enough thought about rates and inflation. Real estate gets squeezed when capital costs stay high and consumers weaken. Airlines get crushed by fuel. Consumer discretionary names get hit because people stop buying what they can postpone. Import, heavy businesses suffer when the dollar weakens and costs rise. That is the other side of the rotation. Every dollar moving into one part of the market is a dollar moving out of another. That is why I say the stock market is not one trade. It is a river system. Push on one side and another side rises. Ignore that and you spend your life staring at the index while missing the actual money movement underneath. Now, the most neglected piece of this whole framework is the dollar. The sixth rule is simple. When the dollar moves, everything reprices. Most retail investors do not understand currency at all. They think in dollars, earn in dollars, spend in dollars, and because of that, they treat the dollar like oxygen, invisible, automatic. But the dollar is not neutral. It is a giant pricing mechanism for the entire market. When it weakens, commodities tend to benefit. Hard assets tend to get support. Multinationals earning revenue overseas can get translation benefits. Emerging markets can breathe a little easier if their debt burden is effectively lighter in local terms. At the same time, imports get more expensive, inflation can get meaner, and the entire assumption that sitting in cash equals safety becomes shakier. That is why I keep saying the dollar is the canary. When it moves with force, it is usually telling you the old comfort is being repriced. A lot of people still have too much faith in cash and long-duration paper because they grew up in a world where the dollar's dominance felt permanent and effortless. That world is getting noisier, And in a noisy dollar environment, you have to think more carefully about concentration in pure dollar exposure. Not because the currency vanishes, because its purchasing power and relative attractiveness change faster than the average saver knows how to process. Now, if all of this sounds dense, good, it should sound dense, because the market is dense. That is why frameworks matter. They simplify without becoming childish. And the institutional checklist I care about is very simple. What phase are we in? Where is oil going? What is inflation doing? And what can the Fed realistically do about it? What is the dollar doing? What happens to earnings in different industries? If this environment persists, what is the market still underpricing? And what is my time horizon? That last one is the one almost nobody respects. If you are trading for 3 days, you care about one set of signals. If you are positioning for the next 2 years, you care about another. A lot of people mix the two and destroy themselves. They buy long-term themes with short-term panic, or they make short-term tactical moves with long-term capital. They cannot afford to lose. That confusion is expensive. Time horizon must match behavior. That is the 7th rule. Now let me make this concrete. Go back to Russia and Ukraine. The index dropped, fear exploded, people fled. Energy moved, defense moved, infrastructure and agriculture mattered. A year later, broad markets had recovered, but more importantly, the winners were not distributed evenly. The money had rotated. Same thing after 9/11s. The initial shock mattered, then defense, security, surveillance, and related spending became the longer tail. That is the pattern. The public always focuses on the event. Institutions focus on the spending consequences and the policy consequences. That is where the edge lives. And right now, what we have is uncertainty on speed, not one clean crisis, a stack of them: tariffs, trade policy, confusion, oil shock risk through Iran, weakening dollar, sticky inflation, a Fed trapped between inflation and slowing growth, broad market valuations still rich enough that they can get hurt badly if earnings disappoint. That is not a normal environment. And because it is not normal, ordinary just hold and hope thinking becomes less sufficient. Notice I did not say useless, I said less sufficient. I still believe in long-term ownership of productive assets. I still believe broad index exposure matters. But I do not believe drifting through a regime shift with no awareness of sector rotation, earnings risk, currency stress, or policy traps is wise. That is where the freeze becomes dangerous. Now I want to say something that may sound harsh. A lot of people use long-term investing as an excuse not to think. That is a mistake. Long-term investing is not permission to become lazy. It is permission to become more strategic. If the environment changes, your awareness should rise, not fall. You do not need to trade every twitch. You do need to understand what kind of market you are living in. That is why I think this moment is so important, because we are watching a very clear divergence. Uncertainty is higher than in most of the classic modern crises. Inflation is not fully under control. The Fed is constrained, the dollar is weaker, gold is strong, oil has proven how quickly it can reprice. And yet the S&P 500 still flirts with record territory as if none of that deserves a larger risk premium. Something has to give. Maybe it is earnings, maybe it is leadership breadth, maybe it is valuation, maybe it is all of them in sequence. But I do not trust a market that shrugs this much while the macro plumbing is rattling this hard. That is not bearishness for theater. That is pattern recognition. And pattern recognition is how institutions make money, while retail investors call them lucky after the fact. Now, what should an ordinary person do with all of this? First, stop thinking cash is automatically safe. Cash is useful, cash is optionality, cash is dry powder, but cash is not a religion. If uncertainty is high and inflation is still structurally elevated, all cash panic is not protection. It is surrender. Second, do not freeze. Review your positions. Ask what environment they were built for. Ask whether they still belong there. Ask whether you are diversified in name only or actually diversified across real economic responses. Third, do not chase spikes. If the thing just jumped on the fear headline, assume you are late to the first move. Look for the next move. Look for the quieter recipients of capital rotation. Look for where institutions are going, not where social media already arrived. Fourth, respect the dollar, respect oil, respect inflation, respect earnings. You cannot understand modern markets without understanding the relationship between those four. Fifth, build a watch list before you need it. The public always tries to think clearly during the event. That is too late. Frameworks are built before they open, not during the panic. That is why I always say I do not want to be deciding what I believe while the market is screaming at me. I want the work done before the screaming starts. That is one of the most valuable habits in all of investing. Preparation makes you calmer because preparation gives you rules. And rules are what protect you from your own emotions when the tape gets loud. Now let me close with the part that matters most. Uncertainty is not the same thing as danger. That sentence will make some people angry because they want uncertainty to mean run. Number uncertainty means mispricing. It means the crowd is more likely to make the three mistakes. It means assets are more likely to be treated emotionally rather than structurally. It means retail and institutions will behave more differently than usual. And that gap is where money gets transferred. This is why I am not interested in predicting the exact outcome of the Iran conflict, or the next tariff headline, or the next Fed sentence. I do not need the exact outcome. I need the framework. I need to know where money tends to go if oil remains pressured. I need to know which industries benefit from defense spending persistence. I need to know what a weaker dollar does to hard assets, multinationals, and imported inflation. I need to know what gets hurt if margins tighten. I need to know whether the move is still in the shock phase or already in the rotation phase. That is enough. That is more than enough, because by the time the average investor feels certain, the institutions have already moved. That is always the great joke. Retail wants certainty, institutions want structure. Structure wins. So if I had to reduce everything I just said into one line, it would be this: do not react to chaos the way the crowd does. Map the money flow instead. Because the market is not paying you to guess the next headline, it is paying you to understand where capital is going before the crowd realizes it already left. That is the framework. That is the edge. And in a market like this, that may be the difference between getting caught on the wrong side and quietly building a position while everybody else is still staring at the smoke.